Welcome back. Today we're starting a new series and it's all about REITs. And we're kicking things off with Medical Properties Trust. This morning on the 30th April Q1 2026 was released. And right at that moment I asked myself, is this a comeback or just a yield trap? Today I'll go through with you what you need to know about this and what Q1 2026 needs to show. And what is personally, just to be clear, this is not investment advice, but simply my personal perspective. In total, I hold 229 shares. My entry price was €5.45. Currently, the price is at €4.49. That means I'm down 18% and already underwater. I've already received a net dividend of €118.63. The 52-week high and low is between €3 and €6 as set by the analysts. Here the target is €5. And Investing Pro sets a target of €4.29. If you also want to use Investing Pro for your fundamental analysis, you can get a 15% discount through my link. MPW is not a net lease like Realty Income, nor is it a residential REIT. MPW owns hospitals, buys them, and leases them out for 15 to 25 years. Hospital operators. As of the end of March 2026, there were 378 hospitals in 9 countries. Countries: USA, United Kingdom, Switzerland, Germany, Spain, Finland, Colombia, Italy, and Portugal. 38,000 licensed beds, about 50 clinic operators as tenants, mission-critical estate. You can't just move hospitals somewhere else. That means they have long-term leases, theoretically defensive. In practice, did last year show otherwise? Things can turn out differently, so now let's get to the completely negative story. A stock that went from $20 to $3, and the number one reason, Steward Health Care bankruptcy. In 2024, MP Medical Properties Trust's largest tenant accounted for over 20% of the rent. May 2024, Chapter 11 bankruptcy. Medical Properties. Trust had to write off rental losses, and in 2024, there was a dramatic net loss of $2.4 billion. The stock went from $14 to $4, all within 12 months. Number 2, Prospect Medical distressed. The second largest tenant, Prospect Medical, January 2025, also underwent a restructuring. Medical Properties Trust had to renegotiate. Rental losses and further asset write-downs. Number 3, dividends. Cut from 29 cents to 15 cents to 19. In August 2023, it went from 29 cents to 15 cents. That's minus 48%. September 2024, another cut to 19 cents. And that's another minus 40%. In total, around 70% of dividends were wiped out in 14 months. And number 4, higher interest rates this year. And then the interest rate issue comes into play. The Fed cut rates less than expected in 2025. Interest rates remain high for longer, which is poison for our REITs. Refinancing is also becoming expensive, cap rates are rising, property valuations are falling, and Medical Properties Trust has $9.7 billion in debt. Every percentage point difference in interest costs around $100 million. That's more interest expense per year. That's roughly the size of the Q4 net income. And that's exactly what I keep describing now. In the weekly reviews, in the reels, that you simply have to keep an eye on how the overall situation develops. Currently, the situation is that interest rates will probably be kept steady. If necessary, they might even be adjusted again, and we simply have to take a closer look at that. If they do go up again, well, we'll have to see. Then the step will probably hold at the bottom for a while. But as I said, right now they're already at the 52-week low. 52-week low. Here, without this being investment advice, you could consider making a small entry because, as mentioned, they're currently cheap, a small entry. If it happens to fall again, then you could, if necessary, buy more in this sector. Alternatively, if it picks up because of political reasons, for example. If you know, okay, interest rates are being lowered, then you could also consider adding another tranche. Because then, you know, if necessary, where things are headed and you can plan better. Q4 2025 marked the return to profitability. Medical Property Trust reported its first quarter of net income in a long time in Q4 2025 with a profit of $17 million. That amounts to 3 cents per share with revenue of $270 million. FFO was 18 cents per share, stable compared to the previous year. The board confirmed the 19th quarterly dividend. The stock jumped 6.2%, plus 4.5 million shares were bought back. For $23.4 million, new properties are being added in California. The big catalyst in quarter 4, a 15-year lease agreement for 6 California hospitals with annual rent of $45 million. Starting December 2026, Prospect Medical will take over under almost identical conditions as before the restructuring. Vibra restructuring. Additionally, in quarter 4, Vibra Healthcare was restructured. A 20-year master lease was signed for $18 million. A one-time payment for outstanding rents plus a post-acute asset acquired here for $32 million. So re-tenanting is also underway here. In the bull case for 2026, re-tenanting is progressing. Prospect and Vibra dividends have been stable since September 2024. Buyback is active in quarter 4, net income is positive, and the loss for the entire fiscal year 2025 is 88% lower than in fiscal year 2024. The goal is $1 billion in cash rent by the end of 2026. Now, let's move on to the official quarterly report for Medical Properties Trust. Today, net income is reported as positive for the first time with a total of plus $33 million, which is significantly better than quarter 1 2025. Previously, we had minus $118 million. The net funds per share here are at 18 cents. This is at Q4 level. In Q1 2026, we had 14 cents, which is lower, but Q4 included an $18 million one-time payment from Vibra. The dividend of 9 cents has been confirmed and was paid in April for Q1 2026. So everything is fitting together well. Total debt is currently falling now at $9.66 billion, which represents a decrease of $36 million. It's currently slow, but you can see positive signs. The CEO remains confident about reaching $1 billion in cash rent by 2026. So the CEO is confident about this. On a positive note, let's move on to everything that's bullish. Bullish. First quarter net income is $33 million, the turnaround confirmed. Fourth quarter was plus $17 million. Now first quarter is plus $33 million. That's 2 consecutive profitable quarters. HSRM is running, rent collection is up from 50% to 75% and will soon be back to 100% in October. Only California cash rent in quarter 2 2026. Quorum plus Honor Health will already be fully stabilized by quarter 3 2025. Dividend coverage. NFFO is 0.14. Dividend is 0.09. That's 156% coverage at the moment. Asset sales are bringing in cash for debt repayment. One more thing I'd like to mention. The entire management team here is also very experienced. And they really know what they're doing, which ultimately benefits us. But you can take a look at that yourself. Back when I first got involved, and even afterwards, that's why I aggressively bought more. So the management is really excellent in terms of how they run the company. It's truly first class. Everyone can see for themselves that the management team definitely has many years of experience here. What's the issue? This is one thing. NFC share down to 0.14 from 0.18 in Q4. The Vibra one-time is being discontinued. Run rate is decreasing. Total debt only minus $36 million. Reduction is too slow at the moment for my taste. But as we can see, there are already some positive signs here. Cash on the balance sheet has dropped from $540 million to $425 million. That's $115 million less dry powder at the moment. Property discount drops from 384 to 378. SNCL is shrinking. The rental base and current demands continue to put pressure on financing, as I mentioned earlier. So what's the conclusion? CO1 is solid, but not exactly spectacular. The turnaround, I would say, is confirmed. 2 quarters in a row. Net income is positive. The tenant story is unfolding exactly as the CEO described. HSA ramps up from 50 to 75%. NOR starts in quarter 2. Quorum and Honor are already fully operational, but NFFO has dropped here and so has cash. The debt has barely decreased, and that's a concern, so to speak. For now, it's a matter of waiting and watching to see how things develop in this quarter, so to speak. That means we now have, well, neutral prospects, more or less. We know there is some improvement, but it's not so dramatic that I would say you could jump in here with full confidence, but it's also not so negative that there would likely be a much stronger correction, at least from a fundamental perspective. Now, let's briefly move on to the dividend. First, the truth about its historical strength. Medical Property Trust has paid a dividend every year since 2005, and for over 20 years, even increased it for more than 11 years, up until 2022. It was one of the best dividends track records in their REIT sector. Then came the cuts, but management did not give up on the business. Currently, it's 9 cents quarterly, 36 cents annually. At a price of €4.86, that's about 7.4%. Before 2023, it was 29 cents per quarter. So $1.16 annually. But back then, the stock was also at $20, and that was a yield of 5.8%. Now, just let that sink in for a moment. So, we're getting in here now, or my entry price is at €5.46. I intend to hold the position for a long time, meaning an investment horizon of over 5 years, even over 10 if things go well. That means if the stock rises from €5 to possibly 15 or 20 euros, which actually isn't all that unrealistic considering where we've come from, because we were at €23.82 and now we're at €5.32. That means we definitely have good upside potential here. And if that's the case, that the stock rises from €5 to maybe 10, let's start with €10, then we've already seen a massive increase here. And if the dividend as a result, or rather the dividend that's paid out might then be, well, currently, as I said, it's at 9 cents. If let's say it goes back up to maybe 1.16 euros and the stock is trading at 10 euros, then I would definitely have a yield on cost of 20%. And that's of course extreme, but it's not unusual, I would say. Especially not over such a long holding period, in my opinion, definitely not. Because we can see that the dividend is actually being increased continuously. Of course, right now it has dropped, but that's not even worth discussing. But in my opinion, the future could definitely be very interesting here as well. In my view, it's quite easy to achieve a yield on cost of 10% here. So, to summarize briefly again, from 2005 to 2022, there were increases overall. The absolute peak here was at $1.16, and at that time the share price was at 20, and that corresponded to a yield of 5.8. In August 2023, there was the first cut, and in September 2024, there was the second cut. And today, it is currently stable. At 9 cents per quarter, which amounts to 36 cents annually, with a yield of 7.4. What's important here with rates? Yield is not the same as cash flow. Anyone who bought at $20 in 2022 now has a 76% book loss and only a 1.8% yield on cost. Anyone who buys today gets 7.4%. And if the dividend drops, and that's been the case for 18 months, there have been no further cuts since then. So otherwise, what else are we taking a quick look at? We'll just go through it very quickly again. Just wanted to check if there are any particular, well, who generally holds here. Currently, Vanguard Group, Fidelity, Goldman Sachs, State Street, JP Morgan Chase, and Morgan Stanley hold these shares, but as I mentioned earlier, these are also real estate holdings. Stories, you can't get rid of them as quickly as a tech stock. Hospital real estate is there to be rented out. Long-term contracts. If the balance sheet gets fixed and interest rates eventually fall again, then the question is, where is the fair value here? So currently it was 4.86. Analysts are at $5.17, and in a bullish scenario, analysts see it between $10 and $14. I've already shared my long-term view. As I said, time is our friend. In this case, I definitely see targets here, possibly up to $15, as not unlikely. But of course, it's also important here to keep an eye on the financing situation and how the next quarters develop. So if we were to reach $15, That would mean a 300% upside from the current $5. Of course, with a longer time horizon, as I had already made very clear, and in the worst case, another stress factor in the end. The dividend would be halved and the stock could then potentially be at $2. Here, of course, everyone has to assess the risk-reward ratio for themselves. Clearly and thoroughly weigh it up. So, once again, looking at the long-term bull case, the balance sheet looks rosy again. Interest rates have normalized again. Tenants are stable. Yield and cost, based on today's entry point, would then be over 18% plus. The buybacks are being continued. Before the earnings, I had defined a total of 3 scenarios. First, a scenario where net income was clearly positive, NFO stable, and debt clearly down. The reality here was that net income was good. NFO was not as good as expected, and neither was the debt situation. That would have been the strong scenario, and I might even have said I would buy more. Now, with the solid scenario, so to speak, profit plus dividend confirmed. Plus, the tenant ramp-up is ongoing, and that currently fits best, solid in my view. That's why I'm not increasing my position at the moment, because I'm still waiting. But as I said, the position is already quite large for me in relative terms. So what is my current conclusion or assessment, so to speak? Medical Property Trust is a classic distress to recovery story, plus a long-term real estate bet. The Crest issue is resolved, Steward has been dealt with, Prospect replaced. The dividend is stabilizing at 9 cents per quarter. Quarter 4 plus the last 12 quarters, net income is positive. Tenant ramp-up is ongoing, but there are $9.66 billion in debt. The refinancing risk is real, higher for longer, interest rates are currently putting pressure, and healthcare rates remain politically risky in the US. But precisely because these are real estate assets, as an investor, you can't get out as quickly as you could with a tech stock. There are 378 hospitals, each with 20-year lease agreements in place. And if the balance sheet is fixed and interest rates turn, then that's when things get interesting. From a long-term perspective, as already mentioned, $15 is not unrealistic. As I said, that would mean an upside of 300%. Yes, with a longer time horizon of over 5 years, yes, potentially. So my personal assessment here is that after the first quarter numbers, I will hold my position for now. And Q2 2026 will definitely be the real test, which will show how things develop from there. That would be it for now. REIT number 1, Medical Property Trust. If you enjoyed the video, I would appreciate a like at this point. If you're not yet a subscriber and don't want to miss any more episodes about REITs or Pharma, I'd be happy if you subscribed. Otherwise, feel free to write in the comments. What is your assessment of Medical Property Trust? Do you own the stock? If so, would you buy more now, or would you wait, or do you already have it in your portfolio? And have you experienced the same kind of shock as I did, with the stock dropping into the negative for years? Then please let me know as well. Otherwise, I'd say we'll see each other in the next video. I'd say the next video will be out on Sunday, so it'll be another weekly review. Otherwise, if I manage to do it earlier, there will also be a Pharma video. Until then, invest successfully.